You may have heard the terms value stocks and growth stocks. In this video, we're going to take a look at the characteristics of each and what they bring to a portfolio. Hi there, I'm Michelle. Welcome to my channel where we talk money and having more of it. In this video, we're going to take a look at the difference between growth and value stocks. Now, in reality, the allocation of shares between these two groupings is a bit more complicated than the simplistic kind of bifurcation suggests. Some shares have characteristics of both value and growth, and in some cases, the waters are muddied even further by some of these shares being considered income stocks as well. So let's take a look at what generally differentiates them. Growth stocks are those stocks that investors believe will deliver a better than average return. These are the market high flyers that are either early on in their growth trajectory or have already shown materially above average growth. Now, this growth often comes at the expense of profits. They tend to reinvest their earnings in sales and marketing efforts, research and development, because they want to keep their growth acceleration fully dialed up. They may already be leaders in their respective industries, or they focus on growth to become that. As they are totally focused on growth and building the company, they generally pay no or very little dividend. They have a generally high price to revenue, price to earnings, and even price to book value. Investors are obsessed with being focused on their results and will quickly dump the stock if they have any perception of future underperformance, which means the share price of growth stock tends to be extremely volatile. Value stocks, on the other hand, are those publicly traded companies that appear to be trading at relatively cheap valuations compared to their earnings and long-term potential. They are the hidden gems without the flashy growth characteristics, which may be trading at a depressed value due to some company-specific circumstances or even an industry-wide circumstance. Investors buy value shares when they believe that they are underpriced and they expect a future catalyst will bring a correction or for their dividend-paying nature. These shares tend to have low prices relative to their revenues and their earnings and their book value. They generally have steady, predictable business models that generate modest gains in revenue and earnings over time. They may also pay relatively high dividends, putting them into the category of income stocks. So let's take a look at which is more attractive in a portfolio. Both growth and value stocks offer something to a portfolio. And as I said at the beginning, the difference between the two is in fact not as clear-cut as the description implies. But broadly, growth stocks bring the wow factor of the rapid increases in value to your portfolio, but they do so potentially at the expense of bringing in income via dividends. And as they are extremely sensitive to the changes in the future prospects of the company, their share prices are extremely volatile. Just think of Tesla or Netflix, for example. And growth stocks can also turn out to be a firework that flares then fails, as during the dot-com era, where you had a lot of companies that share prices shot to the moon and then literally crashed. So the investor has to be extremely confident that they can pick the potential winner in an industry. So it's often more effective to rather go via a basket of these players in a particular industry, or alternatively invest in a fund or an ETF that covers that industry. These companies may take years to hit their stride. Look at the trajectory of Amazon and Netflix. There really isn't an overnight success when it comes to growth stocks. And as an investor, you need to have the time and patience to let them grow. Value stocks, on the other hand, generally offer the optionality should their share price improve when the catalyst for this comes to fruition. In addition, they can provide income to your portfolio through the dividends they pay. Their stock prices tend to be more stable and less volatile than the growth stock. There is, however, the risk on these ones that the investor may get caught up in what is called a value trap. When a company looks cheap in terms of its share price, but it is cheap because of the reason for it, and there's no catalyst to take away that reason. For example, there's new entrants into the market with disruptive technologies that have basically kicked the value stock off its high pedestal. Again, this can be mitigated by investing in a fund or an ETF that targets a whole bunch of value stock in its portfolio, or even a fund or ETF that targets dividend-paying stocks. So it's clear having both types of stocks in a portfolio can add a valuable diversification of strategies, offering the best of both worlds. And this is because growth stocks tend to do better when the economy is doing well and interest rates are low. Value stocks come into their own when the economy is more challenged and potentially interest rates are rising. If you are interested in taking a deep dive into investing further, pop over to my website and take a look at the courses and webinars that I have on offer. If you like this video, please let me know by liking it, share it with any other ladies who want to change their financial story, and thank you very much for listening this far. If you want to listen to any more Money Talk designed for women, please subscribe to my channel.